is my senior vice president in charge of investor relations, and he's always the only guy in the room with a Hawaiian shirt. I don't know why our Californians aren't representing today in the Hawaiian shirts. But it's having a team behind you that gets you to where you are. So the first thing I want to start with today is I want to talk to our esteemed panelists up here and learn about what it is that they've done and how they've structured their teams. So I'll start on my left here with Ben Leibovich, and he can tell us about himself and where are you investing, Ben, and what are you investing in, and how many units and deals and all that good stuff. And I think you even just funded a deal, did you not?
Yeah, we just did. My name is Ben Leibovich. Thanks, Brian. So I asked Brian, 5 years ago, hey, can I join your team? He said, no, you're too good. Go do your own. So I did. I went and did my own. Not quite. I joined forces with Sam Grooms, my partner, over there in the back of the room. Raise your hand, Sam. So we've isolated the Phoenix market. We focus on the Phoenix market for a lot of different reasons. But talking about raising capital, we've got a deal closing, dollars of equity that we raised for these two deals. I started in 2006 with single family like everybody else, went on to small multifamily, and now own about 250 units, plus or minus. I will never buy a small multifamily as long as I live. I will never buy a single family for investment purposes as long as I live. Talk to me later about why, or ask later on in the session why. But I nowadays focus strictly on syndicating large apartments, 100 units plus.
All right, next on our panel we have Matt Faircloth. Matt flew all the way out from the East Coast to be here, so give him a hand for that nice long trip. Thank you, Matt.
It's supposed to be warmer here.
It's not.
Yeah, it's this temperature at my home, and it's supposed to be warmer in California. You guys have palm trees, which means it's supposed to be warmer here, right?
This is Northern California.
Yeah, I know. Oh well, so I'm Matt Faircloth. The author of a book called Raising Private Capital for Bigger Pockets. I got started in 2005, living in a rental property that I leased out to a few friends of mine. Lived there making $60 a month and living there for free. It was my first real estate deal. Quit my job, and after that started investing full time. Have built it up to the point where we really, what my company does is we put private capital to work in real estate. That may be into a syndication, which we do work in Kentucky. We're in Kentucky, North Carolina, and New Jersey right now with projects. We invest in workforce housing for folks that just, I don't like the term blue collar, but you guys know what I'm talking about when I say that. I mean, these are just, working Americans that are, they're earning at or around the median of the area that they live in, and that's the housing that we go for. Some would call that C-level real estate or C-class assets. That's what we focus on. We also put money into fix and flips because some folks want to get their money in and out quickly. I know today's conversation is about multifamily, but what I want to put out there is that you don't have to just do one type of real estate to be successful in raising investors' money. I find syndications to be one outlet that works for our business for folks that want to invest and be in for 5 to 10 years and do an asset. And maybe you get them their money back or partially through a refinance or something like that. But that is a long-term investment. That's one angle that we offer. And that's what today's panel is about. That's something that we're really passionate about. But we also do short-term assets for investors as well. So.
The life of the party, Marco. At least that's what Jay tells me.
I am in job. No one got that? Yes, okay. Yes. Very good, thanks. So my name is Marco. Hello. I do multifamily investing, hotel investing, and mobile home park investing. And I as well started in the late 90s, lost everything in 2009 through a divorce and the crash. And since 2010, through the processes and the network that I have, I'm involved in almost 6,000 units now active. We do some syndication, not a lot. We do And basically, I'm more in the cash flow business than I am in the actual asset acquisition business, so I'm more concerned about cash flow between the debt that's there, the investors that we have to pay back, and the actual cash flow that's there, and whatever the spread is we keep. And we're more in the, I'm actually quite envious that some of you are only in 1 or 2 markets, because I'm in 23 states, and it's driving me bananas. So I'm looking forward to learning some things that will allow me to be a little bit more focused, because some of the assets that I have are terrible. Yes. I'm not the only one, and my nipples are going to cut glass in a second. I am so fucking cold.
It's one of those things you wake up
You
in the
said
morning.
gentlemen, and I looked down, I'm like, I'm not sure if that's the case anymore. My balls have ascended up into my esophagus.
Like I said, the life of the
He just
party.
went there.
Anywho, yeah, so I enjoy having fun, obviously. I actually envy Jay for being able to travel as much. I'm not as lucky. I'm also lifestyle driven. I have 4 kids, but my kids are now older. So between now and 2020, I'm definitely going to figure out how to get myself out of the business, because I am involved in a lot of different things. So looking forward to that. So looking forward to add anything that I can, but I have a lot of experience in a lot of different aspects of the real estate realm.
Right on. No, that's good stuff. And by the way, everybody on this panel is going to be speaking in some capacity either today or tomorrow. Ben and myself are in a breakout session in the breakout room at 2:30 this afternoon. All 3 of these guys are going to be speaking tomorrow in their own presentations, and I've got one this afternoon at 4 o'clock. So if you want to take a deeper dive in any of our thoughts, be sure to check out those sessions. Let me ask you guys something about real estate markets. Now, people always ask me, what's your opinion of the market? And my first opinion of the market is there's no such thing as the word "the" before market, because every market is different, and it goes all the way down to the micro market level. But one of the things we have to do as investors that are seeking to protect our investors' capital is pick the right place to invest in. You have to pick the right asset, and you have to pick the right place. Now, there's plenty of debate on which of those 2 is most important. But let's first talk about markets and find out from these panelists, why do you invest in the markets that you've chosen? And what steps have you taken to evaluate the markets that you've chosen to invest in? And I'll start with Marco.
Well, as I said earlier, I'm more on the return. The returns are more the driver than the location, so I think my approach is going to be a little bit different. For example, I have an asset in Mississippi where the population is 1,000, and it's a 68-unit complex. So with the people that live there, I think I own half of the city. So who would invest, who the fuck would invest in such a small market, other than what has 2 thumbs and is a retard, this guy? But it's all HUD driven rents. It's the only HUD asset that's for 100 miles. So if you have a HUD voucher, you have to live there. So we have almost a 6-month waiting list for people to go there. And we're making out like banshees. It's almost a 22% cap rate on that asset. We got it so cheap. So I'm more, as I said, I think with there's basically 3 things I think that will screw you in an asset purchase. 1 is bad management. 2 is bad purchase. 3 is bad location. And I think location can be compensated with good management and good condition. And if you can sort of, and again, these guys might totally think I'm crazy, but we have assets that are in terrible locations, that are extremely well managed, that are in very good condition, that attract the right customer or the right tenant, I should say. And then we have some that are more B-class assets that are we're fighting a lot of struggle because there's a lot of competition. So we're in a completely different different situation. So to answer your question, I focus more on cap rate and returns, and then back end to see if it's something that we can actually make happen.
Great answer. Matt, you want to chime in?
Well, Ben's got his mic in his hand, so I don't know. You sure?
That's why I gave it to
You're
you.
itching over here.
I gave it to you because I saw Ben. He's
I know.
itching.
And isn't it nice to squash Ben a little bit?
Yeah,
cool. All right.
it's a requirement.
It is. Yeah. So, yeah. So for us, we have a certain equation that we use in investing in markets. It just allows us to take deals off our plate because I think that a lot of deals come in the door, and so for us to be able to push things off and say no, we don't want that, we don't want this. We have certain parameters that we use to determine whether or not we want a deal. We like to see area population of more than 300,000 people, job diversity. Let's see. And I think you have a question. We can get further into like specific parameters with regards to deal by deal basis, but the markets that we choose are. My biggest thing is if people aren't talking about that market right now in bigger pockets, I likely will consider it. So if like you couldn't pay me to buy a deal in Houston or Dallas right now or something like that, because everybody in the world is trying to get to Houston and Dallas. Or Orlando, no offense, but Orlando or something like that. Yeah, right. But everybody else does, Right. So I tend to stay away from the super popular markets. And so I invest in markets that have the parameters that we want that aren't as popular because we like to be one of the fewer horses that are investing in the towns that we're looking at. But just job diversity and a high population of folks that are around the median because that's our tenant base. So that's what we're looking for.
This is a really interesting question on a couple of different levels. So on one hand, Marco's answer was really good. But he also said he wants to remove himself from the business because the management of that business is getting to him. I don't want a business. I've often hosted on Bigger Pockets and I've had disagreements with Brian in public. I don't see syndication as a business. Syndication is finding a needle in a haystack, that one asset that makes sense. Now, how do you define what makes sense? What makes sense is something that's padded enough to compensate for poor management. Because I don't want to be involved. So I have to outsource it. If I outsource management and they fuck it up, I have to have enough padding in the deal to absorb the heat. What helps me absorb the heat? A place where everyone wants to live. Because there's jobs there. Because there's population growth there. So the reason we focus on Phoenix is because it is the growth market of all growth markets. I don't care what the cap rates are. I don't care what the pricing is. I want to be where people have a reason to be. And I don't want personnel to feed because I don't want to have a deal to do so I can pay somebody's salary. So when I come across a deal that's worthwhile, I put it out to my people and we do it. And that doesn't happen very often. So I will never have 25,000 units. I may get to 2,000 and that'll be just fine and dandy, or 1,000. But it's a very opportunistic view of a very specific market, very specific asset in a very specific sub-market locations on a very timed basis with a specific business plan. It's like answering, how do you like the market? It's like Brian said, there's no such thing as the market. All three of us have different objectives, different business plans. Answering this question is a very interesting, lengthy proposition.
It's interesting to see three completely different perspectives on how to approach kind of a similar business strategy, right? And Ben and I, we disagree because it's fun for the two of us. It's kind of a sport where on BP you'll probably see us disagreeing with one another almost all the time, and we probably actually do disagree with one another almost all the time. I probably enjoy it more than you do. But I was saying earlier that we've got two esteemed panelists and Ben. And, I promised myself I wasn't going to do that too. So, we brought up a couple of different strategies here on how to structure your team. And we've got completely different approaches. Ben says, He doesn't like to have employees. He doesn't want to build a big business. You know, at Praxis, we've got, you know, a 50% headcount and have built, you know, quite a business out of it. So, you know, the same business, two different approaches. So tell me about how you structure your team and how do you manage your assets? How involved are you? What's kind of in-house and what's kind of out-of-house? In other words, from the audience looking in, give them a peek behind the curtain of what it looks like to be in this business. And I want to start with Matt.
So, I'm glad you asked that question because it is a very different strategy here on the panel. And nobody's wrong, it's just different strategies, right? So for us, we take people that we've honestly met and grown our team through Bigger Pockets, through people that want to get involved in multifamily, but maybe don't want to be the one themselves that build the team, maybe they want to join a team. So we use folks that we meet on BP that help us find deals, folks on BP that help us fund deals, that help us run. Our current asset manager is a friend of mine that I met on Bigger Pockets, and so he now makes a salary and also has equity because he's at one of our sites in North Carolina right now. And everything like that. And I met him on BP, and so we build teams of people that want to be real estate investors, and they make some income, but they also get some equity too. So we have asset managers that hold the property management team accountable because we outsource our property management. We don't do it in-house. I don't know if you do that, but we don't do the property management in-house for now. We'll probably grow to that eventually, but. The property manager is the one that puts site staff on, that hires employees, and that run the asset. And we have a manager behind them. We also do the construction management in-house. Most of the stuff that we buy needs work. It's typically performing, but it's performing at this level, and we come up with a business plan and we want to bring it up to here. And that's through construction and value add to the property. So we manage that construction in-house with our in-house team. Yet another person that we meet off of Bigger Pockets, and we put some work in the site and pay him a salary, but also give him equity in exchange for running the construction management side of the business. I spend a lot of my time raising capital because I think that that's the core, the lifeblood of the company, and so I spend my time doing that. But I also have a team of people that I meet on Bigger Pockets that help me raise capital for the assets as well. Behind all of that, I have an underwriter who is the smartest person that I've ever met that just runs the numbers on the asset. Uses an in-house calculator that we have to determine the profitability, and he writes the business plan, and just it is the brains of the operation that just sits and crunches the numbers. And he has a team that he built himself off of off of his network and off of BP as well that runs the numbers behind the scenes. So we have a pretty broad team and a pretty strict org chart that we use for moving forward. I mean, we'd like to get to where you're at to 50 people and have specific offices and specific roles and everything like that. Maybe not like an actual sticks and bricks office, but just people that are working from home, that are doing what they're doing as a part of a team and just connecting with them through, Zoom calls and conference calls and just connecting with them that way with specific rules and job descriptions on what they do to run the business.
So you've got a different set of goals on where you're intending to scale to than, yes, for example, like what Ben just talked about. So Ben, tell me about your. One thing I noticed is I see videos on Facebook where you're at the property and you're a hands-on guy. So tell us about how you've structured your team.
Well, I'm not a hands-on guy. I want to see the property before I shop it to investors, but it's also easy to do when I made a decision to only buy things. What some of you know that others may not is that I was diagnosed with multiple sclerosis. So what's important to me is that the business plan can sustain and come to a soft landing for my investors if I get taken out. One of the reasons I have a 50-50 partner in Sam is because that, aside from the fact that he's brilliant, and a CPA with Deloitte background in SEC reporting, which really helps in this business. But I do not want a big team. I never want a big team because things go into disarray if I get taken out. He's the head. Something happens to him, they got problems. He's the head. Something happens to him, they got problems. I have a third-party management with 20,000+ units under management. They have a legal department. They have a reporting department. They have a construction arm. They have everything that I need That just means I have to pay a little more in operating expenses to be able to afford them. It also means I have to find a better deal than somebody else in order to be able to pad that, in order to be able to afford it. But that works for me because I don't need to do 20 deals because I don't want a team. If I do 2 or 3 a year that are really that good, I'm fine. I'm very, very happy. So it's a different perspective. I never want to have a business. I never want to have to hold a hammer. I never want to be at the property because I have to manage the property. For my investors, it's important to know that there's transparent continuity involved with, oh my God, something happened to Ben, what's going to happen? Things are going to happen because I am not involved in a day-to-day basis. I manage the managers. So what I do is I do the underwriting along with Sam. I raise money. That's majority of that is on me. And we do the reporting and we manage the managers. The rest of it, they take care of. It's very simple. I'm not involved with paying anybody's salary, so my construction happens. I'm not involved with paying anybody's salary, so my marketing happens. I don't need any of those things because I'm not trying to grow to where these guys are. And I also don't need to because I'm in Phoenix market. A deal for me is $10 to $15 million on a purchase price that after the value add is going to be $25 million. So it doesn't take too many deals to get to a portfolio of $300 million. So I don't have to have a team. And I enjoy sitting by the pool with my laptop in beautiful Arizona, knowing that I can have a portfolio without having a business. Different perspective.
And as you know, in our disagreement, you can see the way we structured it. We take a completely different approach, and I believe in team as well, and that's why I brought in a whole C-suite team so I can run the business under my little red umbrella on Kaanapali Beach in Maui, and got my phone and my laptop and my iPad sitting right there and can run the whole operation from anywhere in the world. So having a team, whether it's third party or in-house, I think it's really important that you have that backup, because you're right, you can't be a one-man band in this business. Marco, tell us about how you've structured your team and how you get all this done in 26 states.
Yeah, so I have a sort of a unique, I guess, a blessing and a curse at the same time. So I have a fairly robust education company where people want to learn how to invest in real estate. And we also partner with them on their deals as well and help raise capital. So it helps leverage very quickly. We buy about 1,500 units a year across the country. And we have different people in different states, so it allows us to be fairly active. And the challenge with that is a beginner that gets in sometimes makes terrible decisions because they don't necessarily know what they're doing all the time. And this is why some of these assets have been terrible. I don't do any of the management at all. I would rather be shot in the head, or actually, I think be back with both of my ex-wives at the same time. That might be a more desirable outcome than managing an asset. I'm definitely not a manager. I'm not one of those guys. We have local management companies that we vetted and that we have no problem paying 10, 9, 8% to make sure that it's as hands-off as possible with reporting as well, that also have their teams. So Ben, I think that's a wise decision. And I have someone that's in-house that manages those people to make sure that the assets are on track and making sure the KPIs are what they should be, and if there's a huge dip in revenue from one month to the other, we know what the hell's going on. And also to make sure that the revenue is actually being collected, because in hotels it's a completely different animal than in, because then you have daily money coming in versus monthly money. So it's a little slightly different, different KPIs there. But what was the question again?
How do you structure your team?
So the team is structured with there's basically one person in my office that handles overseeing what the KPIs are on the different assets. We have conference calls with the people that are actually mostly owning these things. And I have a small share, around 25% to 33% of a lot of different things. So it's nice to have. But so it's a very simple structure. That's basically it.
Very good. So we've got, I've created like a giant business or behemoth, as you want to call it. Ben outsources to third parties. Matt's building a company with some really high aspirations, and Marco's got partners all over the place. 4 completely different approaches on how you accomplish the same thing. It's pretty interesting to see, those kinds of differences.
I want to be Brian Burke when I grow up.
I never want to be Brian Burke when I grow up.
The feeling is mutual, bud.
Who's Brian?
My best friend on VP, live and in the flesh.
We really do like each other. I hope you understand this.
I think actually you were the second person from Bigger Pockets I met in person, perhaps. The first being Brandon Turner. God, it really went downhill, didn't it? So let's get into the nuts and bolts of real estate. Tell me, picking a market is important, having the right team and structure is important, but also picking the right asset to invest in is really important because, I always say that, a bad syndicator or a bad real estate operator can just completely destroy the best real estate deal, and a great operator can salvage the best outcome out of a completely adverse situation. But no one can really recover very well from a really bad real estate investment. So let's talk about what it is that, let's talk about those nuts and bolts. And guys, tell me, what do you look at first when you see a real estate deal? And tell me something that makes you quickly rule a deal out. Ben, I'll start with you.
There's no such thing as a structurally good building without considering the location. I'll give you an example. If I'm in Ohio, Indiana, I'll never look at a flat roof. I'll never look at a boiler chiller. However, if I'm in Arizona, I'm okay with flat roof. I may be okay with a boiler. If I am in Ohio and there's no double pane windows, I know I have to put them in. If I'm in Arizona, I don't have to. So if I'm in Ohio, or if I'm in and I got a 1973 building that's been kept up, I'm good with it. If I'm in Arizona, I want mid-80s construction. And we're getting into the weeds on why we want what we want, but it's market specific. Just like everything else, location determines a lot of this. So when I get these things, and I get tens of them in my email every day, 99% of them go directly into the trash. If it's too small, it goes in the trash. If it's too big, it goes in the trash. If it's got a flat roof, it goes in the trash. If it's got a boiler chiller in Arizona, it goes in the trash. If the after requisition rents are below $700, it goes in the trash. There's just a set of criteria that we know doesn't work. And we can talk about why certain things don't work. But it's very easy to put 95% of what you see in your email into the trash within 3 seconds of looking at it. If it has the words, the owner put in $3 million, it goes in the trash, because that's my job. I want to put in $3 million to fix the place. If it's somebody else's fix and flip, I don't want it. If it's 60 units, I can't manage 60 units. That's like the stupidest size to buy. I can't manage 60 units because I can't afford management for 60 units. I can't afford CapEx for 60 units. I can't afford shit for 60 units. I got to be 100 units or up but if it's going to be 400 units at $120,000 a pop, I can't raise the money for that necessarily in the 3 weeks that I want to raise money for it. Our closing is 30 days. This is very quick. Thank you, Sam. But this last one, real estate contract, says we have until April 1st. We're closing this Wednesday because Sam decided. So I raised $4.5 million in 2 weeks, and that was a little bit of a challenge, but we did it. But that's how. So 70s construction looks like a bunch of row houses in Phoenix. I don't want that because I can't put lipstick on that and make it look like anything but the shit that it is. So I got to be in 1985. Also, the water is so hard, so it destroys piping. I'm not going to open every wall unless I'm planning to open every wall. And at today's prices, I'm not planning on opening every wall to replace every piece of piping. So I can't go into the 70s because it's what's happening inside the walls I'm concerned about that I can't see in the inspection. There are things like that you've been around real estate for 15 years that you know to expect, that you look for, that says, okay, this is too old, this is too big, this is too this is too that. Trash, trash, trash. So when people ask, well, how long does it take you to underwrite stuff? Well, 1 out of 300 that actually makes it to the underwriting takes a couple hours.
You want to go with Matt?
So, for us, if it's in a market that we're already playing in and we've already evaluated, we pick our markets, then we start looking for deals. So, if it's in a market that we've already chosen and we're evaluating, number one, the deal hits our pipeline. We'll look at a few key parameters, like I use the bigger pockets 1% rule, based on what the asking per door is versus what the projected rents are going to be once renovated, and it needs to exceed the bigger pockets 1% rule. Like Ben, I get stuff in my inbox. It's like, hey, this is a new construction. Pretty much the guy just built it, and they're going to put it as a value add, by the way. New construction value add deal. You can raise rents $25. It's value add, right? So a lot of that ends up in the trash and doesn't even go to our underwriter. But if it makes it past the bigger pockets 1% rule sniff test, then, and if it's not just clearly a deal that I know isn't going to make sense, then we push it over to the underwriters and they do what we call a phase 1 analysis. And the phase 1 analysis is we do a local crime map. We determine the crime around the property because people don't want to live in areas of high crime, and I think that it's very hard to market properties that have lots of crime around them because there are things I can and things I can't change, and I try and look at what I can't change, and if that's going to be a major detriment to the property, then I'll walk. If it's something I can't change, like if rents are a little bit low, or honestly, the deal we did in North Carolina. It showed up really bad on the crime map, but all the crime was from the property. There were 4 active drug, it's a 198 unit building, there were 4 active drug dealers. 4 on the property. So we took care of that. We got them all out. We had the SWAT team out there. It was great. Ask me offline over a story, I'll tell you that. I'll tell you that story later. But, undercover cops acting as maintenance guys was great. But we turned it around and we found out that that's why there was local crime. There was crime in the asset. But we looked at other properties, there was crime all around the property. And okay, that I can't affect. I'm not going to buy all that stuff around the property, so we won't buy that. We also do a local block by block market analysis on earned income, because as I've already said, local earned income is a big factor for us. If people can't afford to live in the complex at the rents that we're going to do, given the market that we're pushing towards, we'll walk. Because if local people can't afford where I need the rents to go for the property to make sense, then it doesn't make sense for us. If it passes a phase 1 analysis, then we'll push it over to a phase 2, which is a full deep underwriting. We can do a phase 1 analysis in about 30 minutes. The phase 2 takes about 2 days, and that's more market research on the rents, assembling a business plan, running it through our syndication software, and everything like that. So that's our analysis.
All right, Marco.
I feel stupid. Because that's a lot cooler than what we do. Thanks. I compensate. So, as I said, I think multiple times, we're more cap rate driven. We don't buy anything that's under a 15 cap after taxes, insurance, maintenance, management. So there's a lot of room for error in our acquisition, and we get at first, more hard money debt to do the acquisition, more an asset-based loan. We stabilize it for a year and a half and then refinance it with cheap debt. So that's really the business model. And if we look at 2 years past history, which is what we deep dive into, tax returns, is there an upside in the area or a downside as far as economic turns go and jobs? And crime is obviously the biggest one. We have a checklist about 15 different things. Crime is on there. Also, school districts is important. If they're in a if they're in a shitty school, we don't want retarded people living there. It's just true. I'm from the Northeast, so I can say retarded. Apparently, I'm from the 80s. You can't do that anymore, right? I don't think so. All the good words are gone. Fuck. Can we say that? Can we say that?
That was another one.
So if we buy it at the right cap rate and the crime is not out of control, and I mean that no violent crimes. If my daughter cannot go pick up the rents, we won't buy it in that area. That's sort of the sniff test for us. Are there good forecasts for the economy, upturn or downturn, and can we make it through the process of buying, getting debt and investors, refinancing everyone out, and then continuing to hold the property? If the answer is yes, then we move forward with it.
And if you can find a 15 cap deal where you're comfortable with your daughter collecting the rent, you found a real gem.
I'll show you 12 of them. We can have fun on this one.
Yeah, absolutely. I think you'll be having a lot of fun on that one tomorrow. You've got a whole 1 hour presentation on that.
I do. And they're created, they're not found. We don't find a 15 cap. You find it. It starts at a 10, and we ended up negotiating down to 15.
That makes a lot more sense. So, once you've found an asset, you found your market, you found your asset, what do you think, what's the biggest risk right now that you see? Whether it's market-based risk or just overall capital stack, what kind of things do you think is the biggest risk, and how are you mitigating that? Let's start with Marco.
Biggest risk. I think management for us is probably making sure that that's honest and solid, and not where things go sideways. You can't really predict the future too much. I think management is really the thing that I think is scariest for us. The biggest challenges we've had in most properties are not anything past management. Once we fix the management, things can go back on track fairly easily. I think management for me would be the biggest, riskiest thing.
Yeah, finding personnel, it doesn't get any
People.
easier.
People are
difficult. Yeah, go ahead, Matt.
So, a perfect example of what Marco just said. We have a site in North Carolina, and the property was 50% occupied, because this is the one with the drug dealers, right? So obviously we wanted to turn a lot of the population, renovate the property, just do a big shift of who lived there, right? So we forced a lot of the folks that live there out, and just not good upstanding citizens causing a lot of problems. So we got the occupancy way down, and the new site manager that the property manager hired just was not creating enough absorption. Like the market wasn't absorbing the units fast enough. And at first we're like, man, is our rents too high? No, they were just lazy. They just weren't doing a very good job. We found out that the leasing agent, they had to turn in a one-page piece of paper to get a commission for themselves for leasing the units, right? They weren't turning in that piece of paper to get their commission. And they weren't financially motivated, they weren't driving to lease the units, and just lazy. So we asked our property management company to let that leasing agent and the site manager go. They did. Our typical our lease up rate was like 5 to 6 units a month, which is abysmal for a 200 unit complex. They put a new site manager in, a new leasing agent. That new site manager and leasing agent are leasing out at 7 units a week right now. And so it's all about people. That is the biggest risk, is the people that run the asset. Once we uncovered that problem and made a shift, the property's been leasing much faster because of the people that are running it. There are other risks that I know people will talk about, like, well, what if the market shifts? When's the big crash everybody's talking about is going to happen? Because of course that's going to happen, right? Yeah. So there are market risks there that are obviously out of my control. And so, as I said before, I try and focus on what I can, the risks that I can mitigate myself. The biggest one is people. As long as I buy the right asset in the right location, with the right local economy and everything like that, it really goes back to people. Yeah, it goes back to the humans that are running the asset. So Ben will have a completely different answer.
I am afraid of everything. And
you know, when you live your life and suddenly like your legs stop to work and you play violin for a living and you can't move your arm in the way you're used to because that's the way you did from the age of 5, and they tell you you have multiple sclerosis and shit like that happens, you learn to be afraid of everything. I buy in high growth market, period. Because, you know, diversification is protection against ignorance, according to Warren Buffett. Growth in real estate is protection against everything. To be in a place of tremendous population growth, tremendous job growth, a multitude of reasons for people to be there is about the only thing you can do to mitigate risk. Now, having said that, I don't know if there's going to be a downturn. I'm not smart enough to know if there's going to be a downturn. I don't know if the interest rates are going to go up. I'm not smart enough. I listen to other people who are smarter. I can tell you that on a bridge loan floating debt that we typically start out with, we're required to buy something called caps. You're required to buy caps on the interest rate because otherwise the bank won't lend to you, institutional bankers like that. Well, I can tell you that a $7 million loan caps for 3 years, starting at 40 bips and going up to 115 bips in year 3, basis points.
No, I know. With dollars, like for $7 million loan, what does that work out to be?
$50,000 is what we paid for the policy. That's about 5 months ago. That the policy that would cap the interest rate from going up to 40 basis points in year 1 all the way up to 150 in year 3 on a $7.1 million loan 5 months ago cost $50,000. Yesterday or day before, we received confirmation from secondary market that they approved caps on a $9.3 million loan with 40 basis points on year 1 and only 100 basis points in year 3. The whole thing is only costing us 25 grand. Okay, so people whose business realize the risk of interest rates going up, in spite of all of the hysteria out there, in spite of all of the nonsense, people whose business it is to underwrite the risk of the interest rates going up apparently don't really see the interest rates going up. Extrapolate whatever you want from that, but you have to be thoughtful about the news you read and hear on CNBC and CNN and all the rest of that nonsense. In my opinion, human factor that these guys are talking about is absolutely something that can bring you down, which is why I source out the best third-party providers that I can. I incentivize them appropriately, and I buy in a high growth market because, well, I do a couple other things. I go above and beyond on the remodels. I do the granite up front, underhung sinks. I replace all of the cabinetry. I go through all the units. I make the best product in the sub-market because when people start putting out rent signs and we're chasing rents down, I want to have the best product in the market at that point. I don't know when it happens or if it even happens. But all I can tell you is I would much rather buy at 4.5 cap in this cycle than to buy it at 10 cap. I've done that before. It's a lot more difficult to grow equity in a 10 cap market than it is in a 4.5 cap market. And I'll be talking about that tomorrow a lot.
So a couple of different interesting things that came out of all that. We talked about staffing and people being one of the big risks. And one of the great things about 4% unemployment is it makes it real easy to rent out your units. One of the bad things about 4% unemployment is it's very difficult to find someone to sit across the desk from that tenant and sign their lease with them. So it is kind of tough. And Ben brings up an interesting point about interest rates. When I closed, I did the same thing as Ben on an adjustable rate loan, floating rate loan. It was I think a $15 million loan. We had to buy a rate cap and cost us I think about 30 grand, give or take. Now we're closing a $40 million loan, and how much is that going to be, right? It's a lot of money, and so some people think that interest rate is the biggest risk. And when I look at a forward-looking 30-day LIBOR forecast from the bond guys, who are considered to be quote-unquote the smartest guys in the room, in December, the forecast for LIBOR, which is trading today around 2.5, is about 2.8 in 3 years. But now the forecast that came out this week, it's 2.4 in 3 years. So, there used to be this consensus that, rates were going to be going up and going up faster than what the consensus has become even over the last 8 weeks. So I think a bigger risk than interest rates to me is yield maintenance and prepayment penalties that restrict you from getting out of debt and selling the properties at the most opportune moment, and instead having a gun to your head with the yield maintenance penalty. That's a bigger risk to me than interest rates. So tell me, let's shift gears. Actually, I have one more question, and we're going to shift gears. Tell me about your due diligence process. Yeah, go ahead, Ben. Yeah.
I think what he just said, if you look at LIBOR drifting down over the last 2-3 weeks and apparently continuing to price down, if you extrapolate that the economy is going to cool down, which kind of market do you want to go in? I'm just saying.
The strong one? Phoenix? There's quite a few. Yeah, that's right. I think, being in...
Not Lima, Ohio.
Yeah, no. You came from there. Even you left. That's saying something. So let's say, tell me about your due diligence process. When you get an acquisition under contract, what do you do for due diligence to determine whether or not you want to go through with that transaction? I'll start with Ben.
Well, if I'm looking at this property, are we talking before being under contract due diligence or after being under contract? Okay, so we're under contract. So we already know we want the property. This is how this works in Phoenix. Phoenix is extremely competitive. So by the time I'm under contract, chances are 100% I've been at the property with the following people, with the permission of the seller. Somebody to get on the roof, somebody to look at the HVAC, somebody to look at the pool, somebody to look at the electrical, somebody to look at the plumbing, the property manager, the regional property manager that's going to have this property. All of these people have been at the property with me. Why? Because the seller wants to know that I'm serious. If the broker is bringing me to them and says this deal is going to be closed, if Ben says he can close at XYZ, he's going to close at XYZ. I can't say that to the broker or to the seller unless I've seen enough of the property to where I feel more or less confident that we're not going to find something ridiculous that will require retrading. That's about the fastest way to flush your career in the toilet, is to come back after you're under contract and retrade. So the due diligence begins before due diligence officially begins. And I'm fortunate enough, and Sam and I are fortunate enough to where we have the capacity to go to the phone and dial the telephone number of the guys in charge at a property management company with $20,000 of management, and they will set up all of those people to be under to be there even before we know we have the contract on the property. That's very unique. It's very difficult to get through the door with people like that. It takes time and effort to build that relationship. But the due diligence starts before we're under contract. After we're under contract, there's an attorney involved, there's the PM involved on all kinds of levels. And then there's Sam involved. And I'm involved in raising money, so don't talk to me about that nonsense. Tell me if we have a problem. Aside from that, I don't really want to know about it. But I see emails flying back and forth. I'm just not involved in that process. I know everything I need to know about the property. The thing with us is that we look for about $300 per door of value add. Our numbers don't work out at anything under $300 per door of value add in Phoenix MSA. For various reasons that we can come back to later if there's time. But what that means is that I'm touching virtually everything. I'm ripping out the kitchens and putting shaker cabinets in. I'm putting granite tops in. I'm doing underhung sinks. I'm doing fixtures, plumbing, lighting. I'm doing flooring. I'm doing paint. We spend on the average between 72 and 7,800 per door, depending on the square footage, number of toilets and all that. $300 per. Right. So, because I know I'm touching everything, really the only thing I care about is the big time mechanicals. Am I going to have to spend $300,000 on the roof? Am I going to have problems with the foundation? Am I going to have to replace a boiler at a cost of $30,000? Do I have to do the big things? The small things don't really concern me because this is going to be a shell that has new things put into it, so I really don't care. Does that make sense? And then the rest of it is better be handled by attorneys because I'm not one, so.
So for our due diligence process, we typically get our property manager to invest alongside us, so they're on the equity side from day one, so they treat it like it's a property they're purchasing as well. So I've been able to get all my PMs except for one of them to agree to do that. So they do a full site audit. We do a physical and a paperwork inspection, right, for due diligence. So the physical inspection is walking every unit in the complex, doing filling out a checklist and doing like a write-up on each unit, counting how many white refrigerators I have, how many black refrigerators I have, how many stainless steel refrigerators I have, how many dishwashers are on the site, everything like that. So we do a full audit of the physical plant inside and out. So everything Ben said. The exteriors, roofs, just age on that. But the property manager that we work with, their construction team, does all that audit. Then we do a paperwork audit, which looks like a full lease audit, which we actually have the PM do as well. They audit every lease that every tenant has, how many months, which ones are coming up for expiration, which leases are at market, which are not, how many tenants are paying pet fees, what's the security deposit that each tenant has. All that stuff all gets audited into a spreadsheet, and then on our side of it, we audit the financials. So we'll probably get something called a trailing 12, but that's just the 12 months worth of the last 12 months worth of financial performance on the property. We try and get a trailing 24, which is the last 2 years, if they can get it for us. Then we also get the last 2 years worth of financial bills. So give me the utility bills, the water bills, any bill that came through the complex. We get copies of all that stuff. We also call the tax assessor at the property and make sure that we're 100% clear what our purchase is going to do to the property tax, because different states have different laws around that. So we get very clear on that. We also call the township and make sure there's no pending violations. The property we just bought in Kentucky, we just found out the guy had like 26 violations that he didn't tell us about. And then we made him clear them before closing, and we also made him escrow the penalties that were associated with those violations too. Because he forgot about that. He didn't tell, that's minor stuff, right? No big deal, right? So we audit a lot of that, including calling the township. We even do stupid stuff where we make sure the property's zoned for what it is. It sounds crazy, but it could come up. So we do a lot of auditing with the local township, going through all their financials, physical audit, and then we also have the property resurvey, which most banks require that anyway. We've had properties that had encumbrances or like the neighbor's shed or whatever it was across the line, unbeknownst to the owner, so we had to deal with that because that's an encroachment. So we've had things like that come up that I don't want to deal with while I'm owning it. I want them to deal with that. So the neighbor's shed had to get moved before we close. So stupid stuff like that. You want to just really, we go in with both hands to figure out that what we're buying is what we think it is. And we've never retraded, although I know we said it's the end of your career and everything like that, but we'd rather have that conversation versus buy something that had a surprise there. So we go all on the due diligence before we close.
There's nothing really to add to that other than calling your psychic to make sure it's the right purchase at the right day.
Or your rabbi.
Or your rabbi, yes. But You have never retraded on a property? Like you find something major during the process and you've never said, what the fuck, like this is not what it was? Like we either have a change to the price or...
I mean, I've walked. I've walked.
You don't even give them the option? They're saying, you know, I hate to do this and I know it's a slimy move, but you promised this, it's really that, what are we gonna do about it? We've never...
I don't agree, and respectfully, I don't agree that a retrade is the end of your career in deals.
It happens constantly where, you know, a seller's a liar and just doesn't say exactly what it is, and you do as best you can, you uncover something, and then you give them a choice. Either A, we're gonna walk, or B, here's
Maybe
what
in
we need.
Phoenix it might,
Maybe.
because of how hot Phoenix is.
So
Maybe I'm gonna start disagreeing with you as well now.
we're talking about different
You
things.
just try it.
If you're talking about physical parameters, the actual, like, physical property, yes. If you're talking about financials, I don't really care what they are.
Yeah.
Because I'm going to be repositioning the property.
You don't care-
I'm not buying what it is right now. What it is right now makes no frickin' sense. What it is right now is 4.5 cap. It doesn't cash flow. It loses money. The reason I'm buying it is because by end of year 1, it's going to be 5.5 cap. By end of year 3, it's going to be 8.3 cap in a market that trades at 5 cap, and I'm going to make my investors the delta of 3.5 cap on that property. This is where we make money. So I don't really get inside, and aside from knowing the loss to lease, for which we have to obviously know where it sits right now, aside from that, current financials mean absolutely nothing for the most part.
We don't fix them at all and reposition them. We just buy them as they are and then just hold on to them. We don't do much to them.
Yeah.
So our models are different. So I
Yeah,
understand.
yeah.
Now I understand why you would not trade again.
Yeah.
Well, I'm going to do something really unusual. I'm going to agree with Ben, and please do not ask me to do this again, but a retrade is the end of your career. But oddly enough, I'm going to agree with Matt, too, and that may seem impossible for me to agree with two different opposing viewpoints, but I'll explain what I'm saying here, that there's a difference between a retrade and a retrade. And what I mean is, if you're retrading for something that you should have seen when you toured the property and dug into the financials, if that's why you're retrading, that's the end of your career. If you're retrading because you showed up at the property to your due diligence and now you got up on the roof or underneath the building and you found something wrong that you could not have seen on a cursory view during your tour and you have to go back and ask the seller for a concession, that's not a retrade. That's a, hey guys, you know, this wasn't the way you represented. We had this on the last deal that we just closed. The sellers, you know, gave us the rent roll, everything. We go and do our 100% unit walk. We find 6 down units. And we're like, guys, you didn't tell us about the 6 down units. You know, it's not a huge deal, but it's going to cost 50 grand to put some of these back together. You know, you guys have to pay for that. And they're like, yeah, you're right. You know, no problem. Not a career ender by any stretch of the imagination. But if I show up there and go, oh, hey guys, you know, I noticed that we got to redo all the landscaping, so, you know, I want 100 grand off. They'll be like, well, you can see the landscaping from the street before you even drove in the parking lot. So, kind of, you're both right, and sadly, I'm agreeing with
You got to be careful because Matt is right. Like we saw, Sam, I don't know if you remember, we saw a pro forma from a broker, and brokers sometimes are less than careful. And this property had
Sometimes?
I'm trying to be nice. This particular property had a parcel of land attached to it, and so when we did our cursory look-see at what we were doing, we realized that there was a tax bill. There were 2 tax bills for this apartment complex because there was kind of a parcel off to the side that they never included. So I emailed the broker. I never got a response, but they changed it in the offering memorandum because I got my hands on the offering memorandum after the fact. Well, yeah, we couldn't see it because the way it was represented, it was 1 tax bill, but in reality, this property has 2 tax bills attached to it. So you have to be very careful with the offering materials. You have to, you know what you're buying, and often enough, there are some people in real estate that are not particularly scrupulous.
No, that's impossible. So we have 5 minutes left. I'm going to shift gears. And by the way, you know, Ben and myself are going to be in the breakout room. I hate to have to do that with you. at 2:30 this afternoon. So if you have questions related to any of this, you can come to each of us during that breakout session, and certainly catch up with Matt and Marco here at the conference to ask deeper dives on any questions you have. I was hoping to have a few minutes for questions at the end, but Ben talks way too much, and there's just no way I can squeeze that in. But I do have one question that I want to ask you guys, and shifting gears, where a number of people in the room raised their hand and said that they're interested in investing in multifamily opportunities on a passive basis, where they're investing their capital in a deal that's put on by someone that's doing all of the heavy lifting. So tell me about what those potential investors, what due diligence should they be doing when they're selecting an investment that they should be that they're considering investing in, and what question might they ask you that no one really asks you, but they should be asking you? Matt, I'll start with you because you wrote a book on raising money. I'm going to pick on you.
Be on the spot first. They always ask the questions you should, like, it's not that they shouldn't ask this, but this isn't as pertinent as they think it is. They always like, well, how much money are you putting in? And it's not as pertinent, I think, because they devalue the sweat that we put in. And sometimes we put money in our deals, and sometimes we don't. But that means that they're devaluing the sweat and the teamwork and the organizational structure and all the other non-monetary assets that we're driving into the deal. And so I have to go there. So that's always a question that a passive investor asks. If you're looking to raise private money, be prepared for that question. But what they should ask that don't. Is like, what's your long-term business plan for your company? What's your 5-year plan, your 10-year plan? What happens if something happens to you? Like, do you have key man insurance? Like, what happens if you get run over by a bus? Who's going to take it over, right?
It's always a bus,
yeah.
too, isn't it?
It is a bus.
It's always a bus.
There's not that many buses in the world anymore.
No, never. There's always a bus.
Right. There's way other ways to go aside from the bus, but hey, could be a llama. Yeah, if you're Jay Martin, it would be. Anyway, so that's a big question that they don't ask, and also they just like, are you just dabbling in multifamily, or are you going to be doing this thing for the foreseeable future? So I think that they should be asking about the organizational structure of our companies. I think they should be asking about how long we're going to be in this business and what our projected longevity is in the space. Not many people ask that, but I think that's where they should go.
That's a great answer. Marco, what do you think?
I think exit and track record. I think, let me see what you've done, what the returns were. Let me talk to other people that have done this, and what's the exit like? Because we all want, an exit, specifically if you're just starting, which is, I think, the crux of the question, is everyone wants to buy and use other people's money to buy an asset, but if you don't have a really clear exit and a really clear structure to how that exit is going to happen, you're actually going to hurt the investors that are coming into the table, and I would never want that to happen, because that could be bad news bears for you as the owner. So I think, obviously following SEC rules as well when you're asking for money. A lot of people tend to post on Facebook, hey, I'm raising cash, and that's something you should never do. But as far as, I think exit having a track record, or partnering with someone that has a good track record, so you can at least learn on how to do that properly, and making sure that you have the right management in place and the right humans in place, which is really the Achilles heel of the business. If you have the right people in place, the right deal in place, and the right exit, I think everything's going to be a-okay.
I think you have to be in a growth market.
I'm surprised
Phoenix.
you say that.
You absolutely have to be in a growth market. Listen, I started investing in a little town called Lima, Ohio. I internalized over a decade the dynamics that take place in something that is not a growth market. And now I've identified and internalized the dynamics of a growth market. This late in the cycle, you have to be in a growth market. That's just where I stand, and you're not going to move me off of it. I disagree with Brian. Surprise, surprise. I disagree with Brian, and we had this disagreement publicly. What's more important, the sponsor or the deal? I think the deal. I think that if you buy in the right market, the right kind of deal that can attract the right kind of third-party providers. Listen, those guys that show up to do my DD with 20,000 units, they're not going to go to your trailer park. They're not going to go to your 50 unit. They're not gonna, because they know you can't afford them. There's not enough money changing hands for you to afford them. But they will go to the assets I buy, which means it's less important. They do the same underwriting I do. They know my IRR on a 10-year hold just as well as I do. They know what my rents are going to be just as well as I do. In fact, you know, I don't set my rents without talking to them. So I think if you put your money into a growth market right now in this cycle, I don't care if it's Atlanta, I don't care if it's someplace in Texas or something, well, Texas is season, but Florida, there's a few growth markets. That's an absolute must right now, because if we have a downturn, I don't care who's managing it, they don't have a magic stick. If that factory shuts down and you've got 30,000 population in that town, and there's only 3 of those factories, you're done. I don't care who's managing it. You're just done.
All right, and I agree. Growth markets are certainly give you a tailwind, and in this phase of the cycle, whatever that phase is, we want a tailwind as much as we can get one, and a market can certainly give you a tailwind or a headwind. So I would choose a tailwind as well. And tailwinds for us, I think our time here is set. I'm going to turn this back over to Jay Martin, and thank you guys for your time, and look forward to seeing you in the breakout.
Thank you all. Appreciate it. We're just going to take a quick 10-minute break for you to use the restroom, grab some coffee, water, whatever it may be. We have a bunch more networking